This is Daniel Young, owner and founder of Adapted Perspective LLC. I believe it's my purpose, my calling to help you identify your dreams and help you reach your financial freedom destination and maintain it so that you can pass your wealth off to the next generation. So you can grow wealth several ways. For us, we're creating and growing our streams of income and growing wealth from those streams. And one of those streams comes from closed-end funds. It was my goal last week to display the closed-end fund master and show you how we compile data, consolidate that data, and then filter that out into our weekly advice, weekly selections, but that didn't work. So that's today. Normally I have a live video Saturday night. Not tonight. This is the video for today. This video will briefly review the data in the closed-end fund master before showing you what I'm really offering within the CEF Master. The data, the consolation or consolidation of the data, and then recommendations on the filtered data. So this is an unedited video. It's not live. At the same time, it's filmed raw at my house. So maybe you hear my cat in the background. Today, maybe you hear my daughter playing with her lightsabers in the background. I'll be going over our financial investment strategy of using closed-end funds, or CEFs, instead of investing in single entity stocks. I will demonstrate how we filter the data housed in that CEF master, and then how we trim that down into more manageable pieces. I'll offer targets based on what we currently own. Yeah, phone in the background, who knows who's ringing. And then also offer suggestions on where to start if you don't currently own a closed-end fund. So the disclaimers. I'm not a financial advisor. I'm a financial strategist. I am not going to take your money and invest your money into the stock market. You're going to do that. The information contained in the video is provided on an as-is basis and does not represent personalized investment advice. Information is from sources believed reliable, but no guarantee or warranty is made as to its accuracy. I may be invested in some of the CEFs recommended or reviewed in the video, and the full transparency of that is the ones we own are colored in blue. I assume no liability for the reader's use of the information contained herein and encourage viewers to educate themselves on the market, to consult with a licensed professional, and to know your goals before investing in anything. Though I encourage you to talk with a licensed professional to get their advice, quite honestly, because I have to say that, but I also encourage you to not be afraid to walk your own path. I don't talk like the herd. I don't speak like the herd. I walk in very limited company, and sometimes I walk alone, and I'm okay with that. Before you invest in the market, you should learn about the market. If you have no idea what you're doing, then start reading. If you want a good place to start, I have a file posted on my Facebook group called Navigate Your Finances. Inside the file section, there is a file called Stock Market Terminology, where I've essentially aggregated a lot of data into one file, and then break down terminology as well as break down, kind of like give you a preliminary taste of the difference between investing in a single stock and the difference between investing in closed-end funds, or compare the two. All right, so let's get into this. So I'm going to share my screen, and there we go. So this is the CEF master list, and I'll review each tab, fully transparent. I have flags of lots of different companies, who's recommended them, why they're recommended, and I keep tabs on those. I update them frequently. Then I have the master list of color-coded files. Shrink this down a little bit. Of color-coded files based on our filtering. So I update this every weekend, and then I also update this monthly. So it's a full system update of all 400 and however many funds there are. I think they're currently 443. Well, that's an easy check. Uh, yeah, currently 443 lines, so really 441. So that gets updated monthly. The targets or everything colored not in white and not in gray gets updated weekly. Purple is recommended, blue we own, and green is interesting. Based on the top, so orange if they're recently closed, dark gray is our overall parameters, which I probably need to update. I try not to buy anything above 16, and the yield needs to be at least 4.6, but really the yield needs to be above whatever the lowest yield we have in our sheet right now. Light blue we own, purple is recommended, olive is interested, and then these. So to get information on closed-end funds, CEF Connect is the best place to go to. Buy alerts are in triple asterisk. Dollar cost average alert is in double. Tracking is a single. Contrarian Outlook is a great place to start learning about closed-end funds in addition to me. And then the overall guiding principle is we don't pay premium. So all of these funds are tracked. All the color code got updated today. And premium just means that this discount to NAV section needs to be negative. So as long as it's in negative, you're getting a discount. So if we look at it as in dollars, AGD currently has a 14% discount. So essentially, instead of paying a full dollar, you're essentially getting 14 cents off a dollar when you invest right now. Now, that may or may not be a good time to invest in AGD. So as I filter this entire form, I put targets on things. And to sort all of that, you get everything together. So before we get back to this, so I give you my stocks, or how and what we bought stocks last year. 2021 data is not on the page, but the dividends are incorporated into this page. 2023 has everything we currently own. Gray are things we've sold. AWP is built well, but I don't like their management strategy. NRO, same thing. There's a lot of good stuff in their portfolio, but I'm not impressed by how they manage their fund. They are grouped into categories. So the top is all monthly, and then you have the total for that category. Shares owned, total invested, dividend a period, an annual dividend, and then the total yield, as well as our accumulated dividends. These are the alternating funds. So the category 1 pays on the first month of the quarter, so 14710. Category 2 would be 25811. Category 3 would be 369 or 36912. These pay on a different schedule. They're listed like USA looks like a category 3, but it pays on the first, or it pays in January, and then it goes 369. KYN and KMF are currently scheduled as category 1, but when we bought them, they were alternate 13710. And then FGB has stayed alternate. It's kind of like a category 2, but it's instead of it being 25811, it's 25812. So they have their own section. Category 1, category 2, category 3. Every category has totals at the bottom. And then there's an overall total. So we currently own X many shares. We have that much total investment, our expected annual dividend, our current yield on cost, our current dividend percentage for the year, overall how much we've accumulated in dividends, and then our overall dividend return on investment, which I want to say as of this morning, we're almost break even compared to our overall loss and how Webull tracks our account. I think we're at 8.5% loss overall, but our dividends are up to almost 8.5%. So we're almost at break even. So as our funds adjust and that overall profit loss fluctuates, as that fluctuates, our dividends are still just going to keep tracking up. I give you the current dividend disbursement calendar, how we've organized things. So you get the scheduled look of things. Shows when we canceled funds and what that looks like monthly. And then you also get how things are currently paying, along with the full 2022 and 2021 data, as well as a running total. And those numbers tie back into these numbers. So as soon as I update anywhere on the spreadsheet, this page auto updates and all of these numbers auto update. I have a section for this video today. Then I have a top options based on what I did last week. So in the master, highlight all the data, copy that, come down here, paste the data. We're one off because when I eventually buy, I like to know what I have now. So insert one over. So we're not looking to buy anything we don't already have. So whether it's recommended or I've marked it for whatever reason, that's going out. Plus, what I would recommend you, we'll say I'm not going to take your money and invest it for you. But what I would buy right now, if I didn't have anything, is already housed inside something we own. So first things first, we sort all the data out. Now we're still left with priorities, which matters, but doesn't matter right now. Next, we want to look at discount. So just because it's got a high discount doesn't mean it's something you should stake your claim to. If there was anything negative, I would cut that out. USA, as of today, when I sorted, was at break even. So it makes the list. If it were positive, it would be cut off, but not today. And then after that, we can go by yield. Put the greatest yield at the top, lowest at the bottom. That ought to be my current cutoff in that other page. So let's say 6.5, which means I would have to redo a lot of these stocks. But that is dark gray yield equals, that should be 6.5, because that's the lowest percentage of what we own right now. But as of what we're doing and what I would buy. So the idea of Cuba is great, and that Cuba meaning that's the ticker. The idea of Cuba is great in that they pay a fantastic yield, but I've not been impressed with the company on how they manage their fund. Plus, it appears that they've sold everything and it's cash only. They are not invested in anything. So it's a DRIP fund. It's a dividend reinvestment plan fund. So they pay you a dividend. So the dividend drops in your account, and then they take the dividend back out and they exchange that dividend for shares into the company, which is great in a way. And you're getting a lower buy-in at, you're getting competitive buy-in at pricing based on the overall DCA value of stock. But at the same time, if you want to own the company long term, I'm more of I like the drip idea, but I'd rather invest those dividends myself. And that it pays a great yield. Yes, it used to be higher, but not impressed with how they've managed their fund. Going down the list, the bond market is cheap at the moment, but there's also no end in sight as to how long or how well long term the bond market's going to do. So Fax would be a great DCA buy, uh, but it's not the best place for our money right now. Same thing with DSL. Love DSL, but not the best place for our money. HFRO is a crazy discount. Um, there are a couple people who really like it. For me, the managers tried to go non-CEF. They tried to restructure the nature of the company and put it to the shareholders, and the shareholders said no. And since then, the price hasn't really done well. The discount has continued to expand, but it hasn't really done much. And I don't exactly trust the managers at the moment. Uh, let's see, AOD, not happy with how the company's been run so far. AGD, we owned a company with the ticker DDF. I loved DDF. They paid well, hidden dividends, company structured well, portfolio structured well, but then AGD bought them out along with a different company. So I'm not as familiar with AGD as I am everything else on the list. Their current discount is higher than it's been historically. They pay an okay dividend, but I'm just not familiar with them. And there's better stuff on the list. HQL is healthcare. It would be a great DCA buy. The discount is higher than it's been, but there's better stuff on the list. EOD, the discount's gone up, but there's better stuff on the list. USA as well is break even. USA is they have the track record of great management. They have the long-term vision for continued growth. It's been as high as $10 a share. It's sold for a premium. They pay a fairly consistent dividend, and at the same time, it's not the best place to stick our money right now. It's if you had all the money in the world, all of these things would be great ideas. Um, but seeing as I don't have all the money in the world, and seeing as you don't either, there's a better place for our money. So USA, when it's break even and discount, is a great deal because it very rarely hits discount. But that being said, there's better places for our money right now. So let's see. So since you're sharing my screen, we can look at some specific funds. IGR is realty, HTY is a good mixture of tech. BRW is a floating rate loan that likes an aggressive Fed. Fed's not as aggressive as it used to be. NCV and NCZ are sister companies that they have a lot of convertible shares. So their managers are able to convert the funds they own to stocks or bonds based on the market. That's good. That's incredible flexibility. But when they're heavily invested in banks and bonds, so their dividend has been cut a little bit. So they still pay well, but they were paying better. NBXG is all technology. Let's look at things specifically. So ZTR seems to bounce between highs and lows. So curve up and then down, kind of up, but then down, down, up. You get the drift. So if you can buy it when it's down, it'll go back up. You just kind of wait a little bit for it to go back up. Uh, they have great diversity in the fund. They've got 582 companies as of November, mostly stocks, some bond, but I like where they're invested. Um, Top 10 you can see here. So American Tower is cell phone data. Crown Castle is cell phone data. Otherwise, all utility and energy. I like that. I think that's good for our current market. IGR is Realty, HTY. Uh, see, Microsoft, IBM, Philip Morris. It's a good blend of tech. Uh, NCV, I'll show you one, but not all of them. So between the sisters, I tend to like NCZ better and that I can get it cheaper. But for whatever reason, NCV seems to perform a little bit differently or maybe a little bit better. JP Morgan, Block Inc., Zillow, Palo Alto, which is tech. Let's look at GLO. I like GLO. I don't like that it's down, but I like GLO. Same thing, very bouncy. So if you can time it right, like right now, it's the lowest it's been, right? If you can time the bounce, uh, and not all of these percentages always add up, um, but of where they're invested. Exxon, that's good. Raytheon is defense. Microsoft is tech. Airbus is the Airbus airplane. Um, FGB is a business development company. So you might have heard of Ares Capital. That's a business development company or a BDC. FGB is all BDC companies. Ares Capital, Hercules, BlackRock, Main Street, Pennant, New Mountain Finance, Barings, Lightsaber in the background. HGLB is a mixture of tech and real estate. And I want to say data management. Um, NML, so Master Limited Partnership and Energy. But at one point, they also did uh, data management with Crown Castle. KYN and KMF are sister companies. Same overall owner of Kane Anderson. Slightly different purpose, but recently announced they were going to merge to where KYN would become, well, so KYN and KMF would merge. KYN would keep its title. KMF would just merge inside. So if you currently owned KMF shares, they would transfer into KYN at a rate lower than 1 to 1. It's like 0.888 to 1. Uh, they're hoping to raise their dividend. Don't know if NML will pop up or not. There we go. NML recently upped their dividend. NML, let's see, NML, KYN, KMF, FEI, and GER all energy management, energy transfer companies in that they might invest in single entities. Like they might invest in Exxon or Shell or Phillips 66, but they also invest in the companies that control the flow. So instead of just investing in the producer of a product, they invest in the companies that control how the product gets from one place to the next. And it's like cell phone, it's like Crown Castle and American Tower. Would you invest in a single cell phone carrier, Xfinity, Verizon, Walmart, Target, or whatever their phone companies are, Mint Mobile, T-Mobile, Sprint, AT&T? Would you invest in a single company, or would you invest in the company that builds all the cell phone towers and leases those cell phone towers to all the cell phone companies and is responsible for transferring all the data for the cell phone companies? You can buy the cell phone company, right? But their stock goes up and down. They're not always on a need basis. Every one of those companies needs the cell phone tower in order to make their product work. Anybody can make oil, anybody can collect natural gas, right? Anybody can produce power, but you have to be able to get it somewhere else. And that's where the MLP and the transfer companies come into play. All right, so I think that's a good place to be. I mean, um, but I've had to sort these and where to go, like which to pick. So uh, oil is whether you're, I'll say whether you believe in green energy, which is a whole different subject and a springboard into a lot of things. But green energy is not sustainable. In order to build green energy, you need diesel. All of those John Deere and Caterpillar trucks and products are diesel based, which means they're oil based. And if we're building a farm of windmills, all of those windmills require diesel based products in order to be built. Now, once those Caterpillar and dump trucks and John Deere guys leave, you have this windmill farm. All of those windmills require oil in order to work, and they require um, a base level speed. Like you have these giant propellers, and they have to turn at a minimum speed. Otherwise, the power of the wind will not push the blade. So they have to have a minimum level of speed, which means they burn oil and gas just to turn. And then the wind pushes them over surplus, right? So to run the wind farm, this green energy farm, you actually need oil in order to make it work. So it's not green in the sense that it's just wind. The windmills also eradicate the hawk populations for whatever reason. They kill off the raptors. For whatever reason, the raptors flock to these windmills and they just kill all the raptors. That's bad. And then when your blades go bad, they don't just recycle them into something else. They get put in a different landfill, a more costly landfill. So it's an environmentally friendly landfill, which just means it has a different code. And they dig a hole and they cover them over. They don't recycle them into anything else. Uh, Green energy is not sustainable. It's sustainable and competitive based on government subsidy, right? So you build this and you get paid by the government to do it, but it doesn't actually mean it competes with nuclear power or oil. And I'll go further on a limb and further in completely comfortable saying it. Like I'll stand alone and say it. Oil is a renewable natural resource. Like you drill down and it's there. Um, but even if you're environmentally friendly, we're going to produce oil for at least another 20 to 30 years. And I think farther. Um, Electric cars damage the environment worse than harvesting oil. Uh, the difference being that the people who collect all the rare minerals and other product for the natural cars, we destroy the environment, and also we worsen the population that's harvesting all the material because it's not done in the U.S. with labor laws; it's done wherever. Um, but we're still going to be producing oil for another 20, 30, 40 plus years. OPEC just cut oil supply, which means costs are going to go back up. So we don't have the great, crazy amount of supply we had a couple of years ago, where the cost of oil actually went into the negative because there was so much oil. The U.S. was producing oil, and we were energy independent, and we were producing more oil than the rest of the world. So we had this giant surplus of oil, and the cost of oil went right. But OPEC is now going to cut supply, and it's almost summer, so we're going to see an increased demand and an increase in price. But then you also factor in uh, there's there is an overwhelming amount of natural gas being produced right now, to where natural gas is just at rock bottom pricing. So those suppliers are cutting supply. So we have this enormous amount of supply, which means prices are down. Well, now they're going to cut supply, right? And the need's going to go back up. So where I would invest is into any one of those uh, energy transfer, oil and natural gas companies. Um, NML, KYN, KMF, FEI, and GER. And weeding it down, FEI has paid the same dividend since the pandemic. It's a great company, but they haven't done anything with their dividend, which I think they're due for a dividend increase, but that hasn't happened. GER has done several dividend increases since we bought the company. KYN and KMF as well, but KMF is going to get absorbed into KYN. And NML has, I want to say, doubled their dividend since we bought the company. So even though we own FEI, it's not first on my list of investment. If you want monthly payments of those, that's NML. If you're not concerned about the dividend, that's NML and FEI. If you're okay with quarterly, that's KYN or GER. It just kind of depends on your overall outlook and what you want to invest in. If you don't want to invest in oil, technology still seems to be oversupplied. It's not at rock bottom pricing. Like it's almost overinvested. But between technology and realty, that's where I would go next, or real estate. So that would be IGR for real estate, HGLB for real estate, and technology, HTY, NBXG. Real estate has been oversold. Pandemic and post-pandemic, the inflation and the overall devaluation of the dollar cost are rising. That's not going to go away if we ever get back to a somewhat equal dollar, or we'll say less devaluation. Cost will continue to go up. If you want loans, or you think we're going to hit a loan frenzy if the Fed stops the rates, that's FGB. If you want preferred payments, so when dividends pay, they have to pay the preferred shares first. And if there's no money left after preferred shares, then all the common shares don't get their dividend. NCV and NCZ both have 95% plus preferred payments right now, or say 95% of their portfolio is based on preferred dividend. So they'll pay regardless. They pay monthly. For us, it's a great DCA buy based on when we bought them, but it's not comparable in the long run to oil and gas. And it also kind of comes down to your overall investment strategy. So if you note the hold time on all of these files for all of these funds, they're earmarked of when we would sell them, ideally. IGR, lifetime. AOD, 20%. And that 20% can be a combination of current values, overall price, could be a combination of the dividend and the current value. Like, see, NML is 5.3% up on the dividend overall compared to 4% stock growth. So we're at a little over 9% total gain, but we're going to hold it long term. I mean, based on projections, oil and gas will be producing for a while, right? So we can ride that high, and then when the price dips again, like it does cyclically, when the price dips again, we can sell it, wait for it to bottom out, and then buy it again. Fax is a lifetime thing. HGLB is long term. FEI is we sell it. It's earmarked at 12. I don't know if it'll get back to 12. We'll pull this up. Hopefully it won't take a while. Right, so there's pandemic. Prior to pandemic, it was touching 12 and above. If we look back further, it should sit around $12. Maybe it's $10. Maybe we sell it at $10, right? But it's earmarked for more than it is now. So NCV, NCZ, they pay monthly. They pay consistently, but it's just not the best place for our money. That being said, if you'd rather focus on preferreds that get paid monthly instead of oil and gas and not the fluctuation of things, it's a safe, and there's no safe place. It's a decent place to be. If you want diversity within your fund, which diversity overall isn't great. Warren Buffett, I don't want to misstate the quote. I want to say Warren Buffett said diversity works if you don't know what you're doing. That way you're spread out. So if you take a loss one place, it's not bad the other. That's closed-end funds in general, right? So closed-end funds take all the diversity out of it. And that way, if we'll look at FEI since it's up, enterprise products does well, okay? But 1OK does well. If Hess Midstream has an off quarter, you have all of these other companies, right? That's 1 out of 74. You have all of these other companies factored in so that one company isn't going to be a huge hit versus if you're just with one company, that's a much bigger deal. So the closed-end funds takes care of the diversity for you. That being said, if you want diversity within the fund, like where you're invested in more things than just one specific pathway, like a master limited partnership invests in mostly energy, right? And the transference of energy versus ZTR, which hopefully this will transfer page easy. ZTR is currently selling for a bigger discount than normal. It has more components to it. It's a mix of stock. It's a mix of stocks and bonds. It's got a quarter weight of bonds. It's got energy. It's got data transfer with Crown Castle and American Tower. If you wanted to know more about each category or each fund, the trick is so if we type in ZTR holdings, white charts, the CEF list will give you the top 10. White charts, you can essentially search 6 times a day for free until they try to force you into a membership. But until you hit that max, you can see the top 25. And if you don't know what the company is, let's see. If you don't know what the company is, all I'm doing is right clicking on these companies with the lines underneath and hitting open, and it'll pop up a separate menu and it'll tell you about the individual company. Uh, Dominion Energy. Right, it'll tell you more about Dominion Energy. But if you want more diversity, and you're not pushing a specific pathway like real estate or tech or oil and natural gas, that's ZTR. Let's see, that is GLO and ZTR and HGLB to a degree, since they have other focuses outside of utilities, the real estate, and data management. But if it's me, I'm going to look at two things, the deciding factors. So oil, I think oil and natural gas is the better investment for us right now. The other thing I pay attention to is the DCA of cost. So I look at not the dividend ROI, but this ROI. So where have we lost the most? So 10, 14, 23 with EOD. EOD is not where I would be right now. 23 with IGR. So IGR would make, that was last week. So oil, natural gas, and the transference of that would be top slated priority. The other I could argue against would be IGR based on our overall loss. Because when you DCA or dollar cost average your stock, you're trying to decrease, it sounds weird, you're trying to decrease your average. So if any of these was below our current average, it would be a decent investment. But I can tell you that NML is above. FEI has not increased their dividend. It's on the list, but it's not a high list. It's not high on the list. GER is currently above what our average is. That leaves KYN and KMF. KMF is going to get absorbed by KYN. So that leaves KYN. So if we look at that cost of what it is per share, 853, compared to our average, our average is 889. 853 is below 889. So we can dollar cost average this price and lower this price so that on the back end, we make a higher return, right? And we also invest where we need it to invest. So how that looks. So it's what did I say it was? 853. So 8.53. And I don't know how much money you have invested, but this is our data based on our data. So we'll need this number. So 853. So I like to buy things in sets of 50 because it's easier math. And I'm not saying we have this amount of money. Maybe it's more, maybe it's less. It's just an example. So at 50 shares, it cost us $426.50 at the current price point. So to figure out what the new average would be, we would add this number and then divide that. So we have 200 already. We would be buying 50. So the total would be 250. And we could lower our price by 7 cents, which is still lower. Okay, so the dividend would increase by another 10.50 on the current data set. We would lower our overall average price. So it's a DCA buy, but it's also on the long term of things, it's a great investment. For IGR, the IGR is 535. So same idea. Plus what's already there divided by, so with 50, we have 150, so that's 200. So we could decrease our average price more because it's currently low. It's just a lower. So same deal. It's a great DCA buy. It looks forward instead of just today. So I generally try to trim things down into 5, but the problem is there's so many good things on the market right now. It's hard to trim things down, but of where I would go, um, I love HTY. I love NBHG. I like FEI, but I like other stuff more. KMF is about to get absorbed. GER is selling above where we are right now. Now, that being said, long term, it's a great play. But for the difference, so we're currently at 1276. See, we already bought one at 1368. Oops, there. So 1368 is still even above that. So that could it will raise our overall average, but it is still lower than the highest place we bought it. Um, I do. I like GER. Um, let's see if I can trim. I like ZTR, but I like this other stuff more. It's 6. I'll leave it at 6. So if it's us, one NML, it's 670. Higher, but not at the highest thing we paid for it. Let's see. So KYN. That's what I would do if it were me. Um, all right, let me see. All right, let me close out some tabs. Yep. All right. So those were the selections for the week. So, oh, and just to be fair, I'll flash them again. Say if we're buying stuff, this is the stuff I'm looking at this week, which we're not buying this week. But yeah, those are the targets for us. Hopefully, this better explains and better overviews our system. It's a mass compilation of data. I mean, I started with flags and individual funds. We sold those funds and bought closed-end funds. Um, I I enjoyed the data, and I still do enjoy the data from the Contrarian Outlook group, but I wanted all the data. And then once I got all the data, it was sorting all the data and how to do that. Uh, we started, and in the interest of just honest, straight, over the top transparency, it's allowing y'all to see what we bought and what we bought it at and the metrics we're using and how that's gone. And you get to see the things we've done well and the things we haven't done well. I have bought things alongside the Contrarian Outlook, and I have definitely done my own thing and bought things apart from their advice. Yeah. Um, yeah, I'll leave it at that. I won't say anything different. It's always a learning game, and there's always more to learn. But in your interest, you can choose to do this all on your own, much like we have, or you can use our system and our data for your needs. My goal is to, yes, one day make this a membership list. That's why it's a membership view. I do have a small group of people that I email with and talk with about funds, and I would like to grow that. And I would like to talk investment and strategy and what we're doing compared to what other people are doing, and help you out on your journey. And compared to single stock investment, closed-end funds give you so much better access. They give you so much better reward than just a single stock. And I think that plays to our advantage. So at some point, yes, the goal is a membership. And until then, I really just want to display the data and display our methodology and what we're doing until I get to actually figuring out a membership and pricing. I mean, it's a ton of data. It's a ton. It's a huge aggregation of information, and it's trying to figure out the best way to price that out. One, and the best platform to host that on. The YouTube videos are great, but is there a better platform to actually host a membership and do the videos on? We'll see. But in the meantime, enjoy the data. That's the whole point. So video wise, the top selections for the week you saw. We are still very much looking at oil and gas long term. But if you wanted a second follow up, that would be real estate. Uh, yeah, and then I'll make another one of these videos for next week. That's the goal. So if you like the content, consider subscribing to my channel, and then also head over to Facebook and join my group there called Navigate Your Finances. Um, if you're on Facebook or not on Facebook, if you search for Adapted Perspective, Navigate Your Finances, you'll find the group. But I believe the link is also below. And then as you approach the week and try to figure out what you want to do, just remember you're the captain of your ship. You have the power to completely change your life and financial future. Many people will offer to help you, but only you can make the decisions, and only you can actually chart your journey. Right? I can come alongside you, I can help you, I can advise you, but I'm not going to captain your ship. That's your job. So whatever you're trying to do, make it happen. Shock your world. It is far more feasible than this world wants you to believe for you to change your life and change your financial well-being. So until the next time, this is Daniel Young signing off. Thank you for watching this far. Hit the like button by all means, please, and subscribe to my channel. So see y'all next week. Bye-bye.